You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
Hey everybody, welcome to another episode of the Practical Wealth Show. What I'm going to do today is we're going to talk about, I'm going to actually relate a story, and this is going to be with regards to insurance, life insurance in particular, because I want you to, the lesson from this is to get out your policies and review them. So I had a situation yesterday where an old client called me at about 73. I helped them a while ago with like Medicare, like a Medicare Advantage plan locally here in Philly. I don't even really do that anymore, but they knew that, I guess I'm all, I know I'm the insurance man, I guess, but all things insurance. So they had a premium due and they couldn't understand why, and a lapse notice. So that if you didn't pay this extra $166, your policy is going to lapse in, 2 weeks. What? And they were curious as to why. So I started to ask questions and, tell me about it. I said, you know what? You have the number? Let's call them right now. 2 minutes into the conversation. So let's go ahead and call them and we'll just straight to the horse's mouth. So I said, look, just give me permission to introduce me, tell them I'm on the line, give me permission to talk to them. And, because if you're, I don't have to be an agent of the company to know what to ask and how they work. Right. And so, but she didn't know that. So she was, appreciative that I was able to do that. And it was really just a few basic questions. What does she have? What's the premium for? And so on and so forth. So what happened was she had some policy loans outstanding. She forgot about them. She's like, oh, I didn't take out that much and never paid them back. So lesson one is if you borrow against your permanent insurance, it is a loan. Pay it back. Then you can use it again. Okay. So a lot of people build up cash value by accident. We teach people how to do it on purpose, and you will not take a loan out until you have a game plan to pay it back. We talked about that, which is part of the money for life for the banking strategy. But she just saw it as a way to tap some money. But nobody instructed her on how to pay the loans back, so the loans were accruing with interest. But that wasn't the big problem. The problem was that she had a product called Universal Life. So I was about to ask, she didn't remember what she had. So I said, well, what's the premium? And she saw, and she hadn't missed her premium. I said, well, the cost of insurance went up. So I says, okay, you just answered my question as to what type of insurance. So it's a Universal Life plan. Yes, it is. All right. So we don't like Universal Life. I don't talk about, because it's certainly, in my opinion, unstable. And because really, and I'll show you why she had new money due. And so let me tell you how the plan works. So the Universal Life was invented by E.F. Hutton, and it was the insurance industry's answer to buy term investor difference, right? And keeping it in an insurance wrapper. And says, well, they want to be able to show market rates, but keep it inside of the insurance chassis. And so they came up with Universal Life. It's more flexible. It's blah, 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 blah. It's really is very profitable for the insurance company. It's profitable to pay agents more, which is why they lean towards selling it, truth be told. And so her problem was Universal Life, when you break it down, is term insurance and a side fund, right? And what that means is it's all in, there's no free money, right? So term insurance goes up every year. See, internally, the cost per thousand insurance increases every year. So what she was being told was that the internal cost of insurance was exceeding her premium payment, basically. All right. And so I asked, well, what does she need to pay to keep the policy viable? Well, now she needs to pay, instead of the $33 a month, it's like 32 and some change, I think, she need to pay $58 a month for the same coverage, to cover the additional cost of the insurance. So what had been happening and why she was having a premium notice due is that her cost of insurance exceeded what she was paying, and the interest rate on the savings side hadn't done what they projected. So they were taking money out of the cash value to pay for the difference between the 32 and what the insurance cost. So she was at the point where they couldn't do that anymore. So she got a premium notice. And the funny thing is, and it's funny because it's not funny, but doing this a long time. And you see those in the illustration. So if you got one of those policies, look in the illustration, look at the ledger, and on the left side, it will tell you, if you just roll your finger down, you'll see where it says, you'll start to see the cash value go down, and then it says 0. And on the first page, it tell you, if not funded sufficiently, premium will not carry to maturity date. I'm paraphrasing, something like that. Basically, the policy is going to self-destruct. Okay, especially with fixed, variable, or which to me is even more risky. And index is very popular now, which the money is going against the S&P 500. But again, internally, the internal cost increases every year. Okay, it's called the mortality charge, right? And so there's just other expenses in there that become a drag on the performance of the policy. So we ended up looking at it. I figured out what it was. She's got to show, look, she had the money so she could pay the back premium that they wanted. And then we set it up to update the policy. So we're going to look at it. I'm just going to review it right now. I'm not, because she's 73, so I'm reluctant to replace policies because, until I know the insurability. I don't know if I'll actually run some comparisons to see if she could do something better, but I'd rather just help her maintain, what she has and show her how to use it right. And, she says, well, I got a son, he's I got his around the same time. I'm sure that's probably the same thing's about to happen. The cost of insurance has gone up, and her premium she has paid hasn't changed. And I don't know if she's taking out like policy loans, but all of those things affect their performance. So what is the lesson to be learned here? Review your policies. Okay. Don't just put them in a safety deposit box. You need to, hopefully your agent is doing an annual review. If you don't have one, call me. I'll do a review with you, and you can find your policies or take a screenshot, and we can do them. Or if you're local, you can come by the office and look at that. So the universal life, they're inherently unstable. We believe in permanent. I like term. There's not either or. We sell lots of term insurance. Term is just, you got to understand what the goal is. Because most people are underinsured. So most people can't afford to get the coverage they need just whole life, truly. And, whatever you're making a year, if you're thinking from the position of human life value, replacing your income to create an instant estate, depending on your age, and companies have a formula for this, but if you take your annual income and multiply it by 15, 20, or 25, you're in the ballpark. And so that's, so if you're making $100,000 a year, you need $1.5 million. So don't talk to me about your $250,000 worth of life insurance you have. That's not enough. You're underinsured. And so I know a lot of people, insurance is a necessary evil. But see, when you're solving for that, well, guess what? You probably need to use term insurance, and use term insurance when you want to get the most coverage for the least amount of money. The key is to make sure that you're using a company where it's convertible to a company that has a really good permanent policy, specifically a mutual company with whole life that pays dividends is my favorite, and in my opinion, the best kind. And, so you want to be able to have that and review that. So that's really a discussion with you and your agent, but if this is striking a chord, review that. So, this person was sold this policy back in 1993, didn't know how it worked. Now, all of a sudden, what if she couldn't afford it? Then that policy would lapse. Okay. If she was, completely destitute, so you've paid for all this asset for all these years, and now it's gone because it wasn't structured right, or you chose an unstable product. So you need to review that. And so what are the lessons I want you to get out of this short lesson? One, review your policies. Here's another one. If you've got term, you may be getting letters where you have the opportunity to convert your term. Look at that. Okay. And you don't have to convert the whole thing, but you can convert pieces of it. And you probably, because most agents don't know how to structure them for maximum efficiency, so they'll just convert it over. What you want to do is structure them so that they, they hold money faster and sooner rather than later. So if you're getting those, you want to be able to convert your policy. Sorry, I forgot to put my phone on silent. First rule of podcasting. And what you want to be able to do is review those. You want to convert your terms when applicable, because what happens is if you wait till the end, let's say you got health challenges, you may, depending on the company, you can probably convert it, but you won't be able to afford it, right? Because it's going to go up multiples of, something crazy like, $500 a year may go up to $4,000 or $5,000 a year. And if you got a 10-year term in year 11, just look at the premiums. Or if you got a 20-year term in year 21. And so what you want to be able to do is to, know that train is coming, and you do it with a strategy, temporary, to get the coverage enforced, to lock in your insurability. See, people take for granted, you'll always be able to get insurance. That's an assumption that you should not make. Stuff happens. People get, high blood sugar, and, things happen. Your license is suspended. If your license is suspended, you can't get life insurance. And so you've got to be able to, to guarantee your insurability. You might have an illness. You might have, prostate cancer, whatever that, or cancer. You might survive, but now the insurance company is not going to give you new policies. So you want to lock in a lot of coverage using the term, and then when you're ready, you can convert that over. But you've locked in your rates, not your age, but your rates, and that is a tremendous strategy. It's never the product, guys. It's a strategy. And here's another thing. You want to review your beneficiaries, okay? If you got minors, young kids, and they're the primary beneficiaries, and then something will happen to you and the money goes directly to them, you've got, $500,000 and you got a 5-year-old and you left the money directly to them, that's a problem, okay? You need to name a, guardian or trustee in the policy, and probably even legally a trust, so that that money is, because they won't leave it to a minor. So it could be stuck where they need money in their strat, but the money can't be touched till the person's 18. So, again, the money is to replace you, and to leave an instant estate. Insurance is not to bury you, folks. And no, GoFundMe is not a reasonable alternative to life. So you need to protect yourself. It's nobody else's job to take care of your family but you. So if you don't, and you got kids, you're irresponsible. And if you don't have kids, because there's living benefits of insurance, you should have it. And to me, and the way we work, insurance is the center of your game plan. So if you want to bet on, probability, on the event that is going to happen, nobody gets out of here alive. So now what happens is, knowing that, let's make that a profitable moment and create multiples of wealth in our families, tax-free. But now you can lose the living benefits to, make everything you do more efficient, with access to capital, to be your own bank. And so if you, we have a book that part of our required reading. And if you email me at kurtmay@gmail.com, I will, ask for the book. I'll send you my mentor's book, Kim Butler, Live Your Life Insurance. And she breaks down the power of insurance at different ages. It gets to the point where if you got a lot of coverage and you don't want it, or you're terminally ill, you can sell it. Insurance is an asset. So there's so many things that you can do with it. You just need to get educated and work with a competent guide that will help you structure that plan. Insurance if you're a real estate investor, insurance makes your investment more efficient. It makes you more money. If you're in business, you can structure policies as a place to store cash, as non-qualified comp plans, where that aren't part of the IRS, where you can put in as much as you want and pull the money out tax-free. So there's a lot of things that you can do with it. So that's what I want to talk about today. So guys, if I'm striking a chord and I've caused you to, I wonder what I have, and you go dig out your policies, look at them, and you got a question, reach out, feel free. I'll do a complimentary review of your program, and we'll see what you got, review it. So at least you know what it is. It's not saying we're going to do anything with it, but awareness is the first step. If you like the book, send an email or call my office 610-622-3121, or email me, Curtis, can you send me the book, and I will send you a link to download Live Your Life Insurance, and do your homework. It's a short book. It's an ebook. It's maybe 60 pages. It's barely a book. It's a pamphlet, right? So it's about a 90-minute or 1 hour read. And folks, leaders are readers. So don't tell me, I don't like reading. You read something. Okay, you need to read 10, 12 pages a day of something that will expand your mind, right? So listen, with that, Curtis is out. I just wanted to give you a short podcast. I hope you have a prosperous week, and you take care. Have a wonderful day.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.